Well, my name's Andrew Elliott, like Sam said, and I direct the portfolio management activities for our ERCOT retail portfolio. Sam already outlined basically our safe harbor announcements, which is anything I say here today will or may not be true, or you may not want to take action on it. So please know that this is truly for information purposes only, and we hope you take something meaningful away from it. What I'd like to do is really focus on one of the points that Joel brought up, which is resource adequacy. Resource adequacy in ERCOT is the hot topic right now. The question is, do we have enough generation capacity to meet demand in the future years? And that's really born by what happened last year in the summer of 2011, where we saw record temperatures across the state in all cities. We saw record peak demands being set basically on a weekly basis. And in August, we had severe price spikes in the marketplace. Some of you on index saw that and were hurt by that. Peak demand records were set, and on one day last year, the demand response that Joel alluded to in his previous presentation had to be implemented in order to prevent rolling blackouts. So that set the stage for the issue, the debate, the concerns, the comments for, do we have enough generation in Texas going forward, or do we have the right incentives in the market to build new generation? So what's going on? And I know that Joel alluded to some of these, so he set me up really well, and I appreciate that. And I'll try to be brief on some of the stuff that overlaps. But the PUCT is deeply involved in what's going on with resource adequacy. They're really leading the charge with respect to policy changes, rule changes, aimed at, and what wasn't really maybe very clear in Joel's presentation, is aimed at sending the right price signals in the market such that generation owners or investors in generation will be enticed to build new generation in Texas. That is the biggest concern, is that as load grows at 4% in Texas, generation growth or investment in generation is not matching that. So at some point, we're going to cross paths, and that's not going to be a very beneficial situation for the state and ERCOT. So the PUCT, as I said, is very involved in this, and they've opened up what we call projects and had many, many meetings aimed at resolving or attempting to resolve the issue. And again, it's intended, the rules and the discussions are intended to change the market structure such that prices, real-time prices or day-ahead prices, are allowed to clear or post, if you will, at high prices, such that those high prices send a price signal in the forward markets for 13 and 14, which I'll talk about in the next slides, that tell investors, hey, this is a good place to invest. I can make a fair return on my investment if prices are at X level. And right now, the question is, are they at that level? So what has the PUC done? Joel mentioned already that they've taken a look at the price caps. They were $3,000 at the advent of the nodal market in 2011. They recently increased them to 4,500 megawatts effective August. They are considering raising those what we call system-wide offer caps. It's the price that generation owners or what we'll call virtual offers can offer into the market to clear. So it's not the absolute price cap. I want to make that clear. It's the offer cap. You can't offer into the market at higher than 4,500. What are they talking about in the future? Numbers that have been published are $5,000, $6,000, $7,000, and the recent Brattle report, which Joel did a very good job of outlining, mentioned increasing those offer caps to $9,000. And that means that the real-time clearing price can clear at $9,000. The day-ahead clearing price or settlement price can clear at $9,000. So what did the Brattle Group report also talk about? They wanted, in order to resolve the adequacy issue, is $9,000 high enough? Maybe, maybe not. Demand response is going to be a key play in resolving the issue. How do we entice demand response to play in this market? How do we sufficiently remunerate them for participation, for turning off when they'd rather be making the widgets, pumping crude out of the ground, running retail stores, managing commercial real estate properties? How do you entice them to do that? And then they talked about implementing Northeast, what I'll call Northeast style capacity markets. Capacity markets are basically an administrative regulated payment to generation owners. And that's basically it's an annual payment. And the algorithm runs and it spits out a number and it says generation owners get paid this amount of money for having generation there to serve load. And that is intended to be an enticement, one, to keep the generation there, and two, to invest and have basically a revenue stream from the capacity payment. Capacity payments or capacity market structures, the cost of that is ultimately borne by the end user. So a lot of debate is going on right now about what is the right solution. And in some of the other slides, I'll go into a little bit more about what some of the commissioners are really leaning towards. There's not necessarily a consensus at the commission on what the right thing to do is right now. ERCOT. What has ERCOT done? And I don't want to go over all the list that Joel did, but I'd like to pick out the top things that I think are important with relation to the ability or allowing the power price, the clearing price, to clear high. The protocol changes that were approved by what we call the stakeholder process. Joel mentioned ERCOT. What is ERCOT? It's the grid. It's the people at ERCOT. It's also all of the people that participate in the process of making rules that all market participants have to play by. So at the stakeholder process, the committee level, which we're very active in, there were some significant changes. Reliability unit commitment, what we call RUC. If those units are deployed for capacity, or RUC is committed for the capacity, that energy price will automatically go to the system-wide offer cap. So that's a tool or a mechanism that says when there's scarcity, generation scarcity, and we're running into or out of generation to meet load, then we need to send the right price signal for people to turn on their generation units, one, and to send the right price signal in the forward markets that say to investors out there, this is a place where I can make a fair return and I should invest in generation in this state. Two other changes in the methodology or protocol changes were a similar rule where when responsive reserve is called on or required, the energy price will go to the cap at that point. Responsive reserve is called on when we lose large amounts of generation all at once. That's an example of why we would do it. If a nuclear generation unit went off 1,200 megawatts, responsive reserve would typically kick in. And at that point, you would say, here we go, we need to go to the cap. That's a scarcity event. Also with regulation up. Regulation up is turning a generator up, and that would be only for capacity reasons, not just to balance the system frequency. So when it's deployed for capacity, it will also go to the cap. So these are basically three changes that have been made in the last 12 months that will help push prices up in order to have investors come here and build new generation. So I say all these things and you go, well, Andrew, you know, that's all well and good, but I'm an end user here. Well, show me the proof. What's the resource adequacy issue? Well, we talked about generation and the amount of generation. Joel had a slide on that. I'm going to turn this into reserve margin. Reserve margins, and I've laid it out here as a percentage. Basically, reserve margins are how much excess generation you have over your expected peak demand. And you have to have a reserve margin that is sufficient to account for outages, transmission issues, catastrophic events, such that we lose 4,000 megawatts or 5,000 or 6,000 megawatts of generation unit availability. We still have enough to provide and meet load. And as Joel said, 13.75 has been determined the target reserve margin. So what does it say? What's the story? Well, in 2010, we can see that ERCOT, in its CDR estimate, thought they had 21.5%. SERA, an independent energy consultant group, worldwide consultant group, also publishes what they believe to be capacity reserve margins for various ISOs across the world. And I pulled their data, and at that time they thought it was 16.5. Basically, when we looked at it, it was about a 15.3 effective margin. Now we come to 2011. The CDR said 17.5. SERA estimate was closer to 12.7. The effective actual reserve margin for the summer that we calculated was just about 9%. So we're looking at 2012. And this 9.4% that I have there is, I need to caveat that, and I have it there in the graph. It's based upon the seasonal assessment update. And Joel alluded to two types of estimates: capacity and demand report, which is an annual report, and it's done on macroeconomics and macro view of the system. The seasonal assessment is done twice a year, and it's done before the summer and before the winter. And the seasonal assessment does really a microscopic look at what are the system conditions, what are the availability of resources as we know them now, what's the expected weather forecast, what are the expected true dynamics of the system going into the summer. And going into the summer, they said 9.4%. SERA had 12.6. It's not really a seasonal assessment. That's their annual assessment. The effective actual reserve margin, as we kind of looked at it, was about 11%. So it's higher than ERCOT thought it would be. As you guys know, the summer was not nearly as bad as it was last year. We had hot temperatures, but what happened last year was 109, 107 in all of the cities in Texas. This summer we had 107 in Dallas, but it was 95 in Houston, 102 in San Antonio. That makes a huge difference. So we were much better off this summer. So what is it about the future that makes us concerned? 2013, we look like we're above the reserve margin, everything's fine. But it's 2014, 2015, and beyond that we dip below that target reserve margin. That is what everybody is focusing on, the PUCT, ERCOT, all the stakeholders in Texas. They're looking at that and saying, if we go here, what are the repercussions for reliability? So that's what we're here to talk about, is what are the implications. So this slide, I know it's busy. Let me see if I can kind of frame it up for you. It's the forward prices represented in heat rates, which I kind of call the relative value of a generation unit. And I say relative because it's all based upon where the natural gas price is. So heat rates are the forward power price divided by natural gas. And what I've done is I've charted it here since the beginning of 2011 and taken it to current day and shown the trends for Cal 13 Houston Hub and Cal 14 Houston Hub. So these are forward-looking prices. If we were to take this back to, say, 2008, 2009, those orange line and blue line, 13 and 14, would be running just about parallel. They wouldn't have changed much. Heat rates have been relatively stable up until last summer. They've been running around an 8 heat rate. So let's go through and see why they've changed. The first major event that I identify is EPA. EPA announces CASPR, what we call CASPR. When you read it, it doesn't say CASPR, but that's what everybody calls it. Cross-state air pollution rule. It was one of the major EPA clean air legislation acts that was being put forth to go into effect in 2012. And at the time, no one thought that it was going to apply to Texas until July 1st. And they just, like they dropped a bomb on Texas and said, oh, well, here we go. We've got all these rules, and we need you to meet pollution standards by 2012. And Texas and many other states said, that's impossible. I don't know how we can do it. That's going to jeopardize reliability for the state. So that kicked it off right there, and you saw things start to jump a little bit. Then we see August come into play. Summer heat, new peak demand records, and price spikes. Price spikes went to 3,000, went to the cap for, I think it was 13 or 14 hours last year. That sent forward prices moving up further. See the trend. Then there's the debate over around CASPR concerns. Many states, including Texas, filed lawsuits against the EPA and said, you can't do this, we're going to fight you in the courts. And so they did, and there are other companies and states did that. So there's ongoing debate and uncertainty around what's going to happen to forward energy markets, because if you shut down coal units or make coal units invest in scrubbers and other technologies, it's just going to add the price to the electricity that we all buy. So they started looking at that. The next thing was, at the same time, ERCOT protocol revision and approvals. I talked about them on the previous slide. A lot of discussion at the stakeholder process around what do we need to do, how do we tweak the rules such that prices are sent in order to create new generation to meet this reserve margin deficit that people think is coming. So rules were modified, changed to allow prices to clear at the cap more frequently, and people saw that in the market. So what happened here? CASPR was stayed by the courts. The courts said, you're right, guys that are filing, this was unlawful. It won't stand, and so they stayed the CASPR. And so at that time, the market said, oh, let's take a breather. CASPR's not going to be in effect. It likely won't be reignited or talked about until way out here in 14 or 15, if ever. So that was stayed, so it calmed the markets. Then we have continued discussion at the ERCOT stakeholder process. We have steep increase here. What's that due to? There wasn't really any particular event, but what happens in markets generally is that as you get closer to peak demand in summer and people are concerned about what's going to happen in the summer, like ERCOT, the experience that we had in 2011, the market was starting to get jitters, basically. Do we have enough? Are we going to see a repeat of last year? And so what happened is the market just moved up, moved up, moved up on fears of what's going to happen during the summer. And we got into the summer. It was a relatively mild summer. Really didn't happen. Everything pulled back. As we're going through this whole process, we've already talked about the PUC discussions. raising offer caps, instituting capacity markets. September 28th was supposed to be a big day for the PUCT with respect to announcing a direction on where they wanted to go, or even announcing what price caps they wanted to see implemented. That didn't happen. They delayed it. So we're not sure where that stands right now, what timeline they're going to be on. I'll talk more about that in a little bit. But no discussion, no decisions at that meeting. So generally, overall, generation resource adequacy concerns for 14 through 17. That's what we're looking at. So that's heat rates. And you guys say, great, Andrew, heat rates. What, you know, that's great. I don't buy heat rates. I'm not interested in them. What's my power price? So this is a graph of natural gas for 2013, and I've plotted both North Hub and Houston Hub on the same graph here. It goes back to 2010. On the left side is power prices, and on the right side is the NYMEX natural gas price. What you notice here is gas 2 years ago was $6.75. Today, I checked it this morning for 13, it's just about $4. So it's dropped, call it 35, 45% here. Here are your power prices. They were $57 2 years ago. We've dropped all the way down here to about $40. And you say, how can that be? What, you know, you just showed me a heat rate graph that says we're going like this. Well, heat rate times gas equals power price. So as gas falls, so does your power price. The gas price fall is outweighed the rise in heat rates. So the takeaway from this slide is wholesale power prices still near lows in spite of the rise in heat rates. What's the takeaway here? Natural gas is maybe making a move one way or the other. I'm not saying it's going to move, but that's what you need to watch out for. The last 3 weeks, we've moved up a little bit, so keep an eye on the natural gas market. So I gave a discussion or a speech, if you will, last year just about this time, and I talked at that time in Dallas. We talked about what happened in the summer and what were the implications going forward. And so I pulled the slide from last year, and I thought we would go over it. In black is the slide itself. In green is an update. What's happened? What have we seen? I said, watch out for increased price volatility. Did that come to fruition? Well, yes and no. Yes, in the form of that the forward power markets are moving up. And you saw the chart. They move up, they come back down, they move up, they move up, they come back down. So there's price volatility in the forward market due to uncertainty around the regulatory process. The summer of 2012 was relatively mild. Price volatility in the real-time and day-ahead was relatively muted. Possible upward pressure on forward power prices, yes, in the form of heat rates. They can continue to move up. For power prices themselves, they look like they're coming off their lows right now. So keep an eye on that. I said, watch out for lower reserve margins in the future. That seems to be the case. That's why we're here. That's what we're talking about. It's the heart of the issue. Mothball generation units return to service. Mothball generation units basically are units that there's different degrees of mothball. Mothball, you just put it and you never want to run it again. Other mothball situation is, I'm just going to keep it running, I'll keep it hot, and I'll have people there to man it and keep it ready to go. We did see mothball generation units return to service this summer. GDF, NRG, and Luminant brought back units for summer peak capacity. But what I'll say here is that of those 2,000 megawatts of mothballed units came back. 2,000 went into mothball right after the summer of last year. So what came back really was what was there last year anyway. So my second part of this sentence is no long-term mothball capacity units, meaning those that weren't on before summer of last year, have come back. We did pull some back that generation owners thought wouldn't be economical. We turned them back on for this summer. Some of those are going back into mothball until maybe next summer. Increased interest in building new generation in Texas. Yes and no. Panda, I don't know if anybody's familiar with them. They're a investor in generation. They have announced a 750 megawatt unit to go online or right around 2014, 2015. We have performed upgrades on our units to increase the output of our physical generation. That's about 150 megawatts or so. But in spite of that, most generation companies and the word on the street is, and the banks and the financial community says that the forward power curve is not high enough to entice investment in Texas. You can't make a fair rate of return by building generation in Texas given the current price levels. And then my comment here at the bottom is 1 week of high prices to drive investment. It doesn't look like it based upon what the financial community is saying. So another slide from last year, bullish and bearish indicators. What I've done here is I've just color-coded them. The green, these are from last year. The green indicates what actually came to fruition. The red indicates what didn't really materialize. And I'm not going to go through all of them, but a few of them jump out at you. Bullish indicators, possible reduction in the number of operating gas wells. That did come to fruition. We've dropped about 53% from last year. The number of gas wells is down by 53%. Proposed clean air legislation, CASPR, that didn't come to fruition. We were concerned about it last year. The courts stayed it, so that didn't end up being a bullish factor. Reserve margins, we talked about those. Those are a concern. They continue to be a concern. The nodal market structure, we were watching the rules and the rule changes that were being proposed at that time. They did come to fruition. There were changes that allow now the energy price to clear at the cap more frequently. So those were implemented. Hurricane forecast, people were saying that we were going to have an active hurricane season last year. That did not materialize. Bearish indicators. What were we thinking last year? Natural gas from shale production continues to grow. It does continue to grow, and it's growing as a byproduct, really, of crude exploration. When you drill a crude well, you get some gas out of it, and so these guys that are drilling gas wells in North Dakota and in other areas of the country are also getting gas. So that's having, you know, it's basically free gas for them because it's just a byproduct. And they're able to sell that and put it on market and just take whatever market price is because it's a byproduct. Natural gas storage level, and this is the U.S. natural gas storage level. We were expected to reach all-time highs last year, and we did. We set it at, I think it was 3.85. That was all-time high for storage in the U.S. And commodity analysts predicted that we would remain below $5, and that's true. Anywhere from $2.75 to $3.75 is where we've seen prompt month natural gas or real-time gas, or daily gas rather. So, what are this year's updates? And I'm not going to go through them all. Just look at the bold ones here. Clean air legislation. That's definitely on the table still. Aside from CASPR, there are a number of different clean air legislations that has already passed in different forms and in different fashions. That will provide upward pressure on natural gas prices because it is doing is enticing people to build natural gas units instead of coal. Coal is dirty and bad. That's the name of the game here in the last couple of years. I'm not supporting that. I don't say that that's the case, but that's what the EPA is enticing people to do, is retire coal units, build natural gas units. When you increase the demand for natural gas, you increase the price. ERCOT reserve margins continue to be a concern. We saw the graph for 2014 through 17. That is a big concern. The nodal market structure, PUCT and ERCOT, considering changes to the offer cap. Will it go to 5,000? Will it go to 7,000? Will there be a capacity market structure? Nobody knows at this point. Coal to gas switching, that's a big one for natural gas and possibly for Texas. What's happening is gas has fallen to the point at which gas units are more economical to run and produce electricity than coal units. That was almost unheard of 2 years ago, but now it's commonplace. And so a lot of the demand, incremental demand for natural gas is coming from those utilities or generation companies across the U.S. that are saying, I don't need to run coal units. I'll run that 10 heat rate gas unit, and I can make electricity cheaper than I could with my old coal unit that used to be a baseload unit. So fundamentally changed the generation mix, not only, well, partially in Texas, but across the U.S. What are some of the bearish indicators? If there's incremental investment in Texas, then that could have downward pressure on power prices. More generation means you have more padding, more capacity reserve. You might see less opportunity for prices to hit the cap. Transmission upgrades that Joel mentioned earlier. If we increase the ability to move power from the west out of basically free energy, wind, and able to move it to the north zone and the Houston and the south zone, that will lower prices across the grid. Shale production, we don't need to get into that. That continues to grow. And the prospectus for storage levels this year, we could hit another all-time high. We're already at 3.72 BCF, and I think we have 3 weeks left in the storage season. So you could easily see us hit 3.9 TCF, and that would be another all-time high. So what does it mean to you? What are the implications to you guys? Deja vu is in there because they seem to be the same things that we were concerned about last year. Support for higher energy prices in the form of increased heat rates. Let's keep an eye on that. Watch the natural gas market. That's going to be the key. If gas starts to turn around, that can quickly increase the cost of your power. Increased price volatility. Will they institute new price caps? Will there be other scarcity pricing mechanisms that come into play? Demand response. Do you have the ability to participate in demand response programs? If you do, the value of those programs may increase. It may not be next year or the year after, but over time, the value of it for your ability to reduce load during peak periods and get compensated for that is likely to increase. Retail electric providers at risk. If we see the system-wide offer caps increase to $5,000, $6,000, $7,000, there's a lot of money at risk. For those companies that don't hedge effectively, that don't have risk management acumen, those people are naturally at risk for being exposed to those energy prices and not managing their portfolios properly. So focus on reps that have proven track records, that have access to collateral. The cost to participate in ERCOT is going up because of credit requirements. And if you don't have access to cash and collateral, you can't play. So evaluate the market conditions. Take a look at your bullish and bearish factors, your own. Take a look at those. Determine, is it likely to rise or are we likely to fall? Reevaluate your risk tolerance levels. Are you a risk taker? Do you, are you on a pass-through structure so the cost of power doesn't really matter to you? Is index right for you in the face of possible increases in the system-wide offer cap? Reevaluate your power contracting timeline. Is it time to renew early? Should you be looking at reps to get some quotes for your next contracting period so you can properly set your budgets? That's probably a good idea to recheck those prices. One thing I want to add here, and which I think is the most important thing, is really stay informed. There's 3 ways to stay informed in my mind. Is ERCOT website has information on what's going on at the committee process. They have a news page that has pertinent news postings. Stay informed with what's going on. ERCOT posts when they change market rules. They'll typically have articles about that. When the PUCT does something, they'll comment on that. Look at the PUCT website if you can. It's a little more complex, a little bit more brutal to navigate, but that is a resource for you as well. They have webinars, meaning their meetings are simulcast on the web. So if you want to watch a particular PUCT meeting and you know it has pertinence to you because they post the agenda on the web, you can log in and you can watch and listen to the webcast. Most importantly, get with your rep. GDF we pride ourselves on being an information leader. We do seminars like this, hopefully to help educate our customers. So please feel free to contact your sales rep and ask questions. I often get on the phone with customers and have discussions about what's going on in the market, what we're seeing, what are the fundamentals in the marketplace. We can't recommend or advise you to do a specific action, but we can lay out the fundamentals and say, hey, you should be looking at this, you should be looking at that, keep an eye on this, keep an eye on that, just like what we've got in the presentation today. We have a weekly email that most of you probably are on, so we provide updates on current events, current market fundamentals. So please take advantage of that with your sales managers. Contact them, let them know what you're thinking, let them know what you want to know, and we will get the right people to answer your questions. How am I doing on time? We got to go? All right. So that concludes my presentation. Thank you very much.